knows that investing for retirement is crucial, but certain mistakes can actually crush your retirement savings.
And nobody wants that to happen. Here to help us is Jim Heafner. He's the president of Heafner Financial. He's known as Carolina's retirement coach and helps us get financially fit. Hello, sir, and how are you doing today?
Doing great. Thank you. Good to see you.
Good. We're going to be talking about, there's a lot of aspects of retirement we can talk about, but we're going to focus in today on life insurance. So we need you to go give us a rundown of the basics of life insurance.
Well, so I think one of the questions is why would you want life insurance in your plan, especially retirement plan, right? And the problem I see is that many people dismiss it as a bad use of money.
Right.
But if you look to see who owns life insurance, it's the wealthiest families in America. It's the biggest corporations in America. It's the biggest banks in America. Why? Because of leverage and tax-free compounding. Now, there's two basic types of life insurance, term and permanent. And they both have a purpose if they're designed properly.
So you're mentioning these two types. Can you explain the difference?
Well, so term is for a term of time. You're buying it for a year, 10 years, 20 years, 30 years. And when it terminates, it's over. Now, can you renew it? Yeah, you could, but it could be outrageously expensive at that time. Permanent is meant to last you a lifetime. So it's going to pay off a tax-free death benefit whenever you pass away. Now, people often dismiss permanent insurance saying, well, I don't need that, it's too expensive. But what they forget is that in addition to paying the death benefit, whenever you die, it's going to pay off, whereas with term, it probably won't. You probably will cancel it before you die.
Right, okay.
But you have a death benefit that's tax-free and living benefits.
Okay, right. I got it. Yeah, I got it. So let's go ahead and dive more into the permanent. In permanent, we got a couple of things that we have to deal with. That's universal and then whole life. Yep. You said that has a cash value associated to it. How can we use that as people to go ahead and really maximize the benefit of having life insurance?
Exactly. So in addition to your death benefit, permanent does come in different forms. The whole life comes in the form of index universal, universal variable, all these things. But the point is it's there whenever you die. But there are benefits for you while you're alive.
Okay, what are the benefits? This is what I want to know.
What are the benefits while you're still there?
Cash value and borrow it out over your lifetime, income tax free. Now, the magic of that is you're not really taking your money. Your money's still there growing at a higher rate than your borrowing rate, so it's getting bigger and bigger. So it helps you extend that of your lifetime. So let me give you an example.
Okay,
I've got a client who's 55 years of age.
Okay.
And he wants to retire in 10 years. And he wants to save his money in the meantime in a tax-free way, so when he's retired, taxes don't matter to him. He's free of that problem. So he's going to just put away $100,000 per year for 10 years. Now, when he's 66, he'll start taking money out, $125,000 a year tax-free income for as long as he lives. Now, if he dies, his wife gets $1.5 million tax-free income. If he needs long-term care, there's a $30,000 per month benefit. So I call these types of policies the index universal, which is really popular today because of its high growth rate, the Swiss Army knife of financial plans, because they do so many things at the same cost.
Right.
So it's important to know that life insurance can be a valuable component of your plan if it's designed right. So make sure you have someone help you that can help you get the right plan. And consider this, if you don't qualify because of your health or you think you're too old, well, I'm still buying life insurance at my age, but if you think you're too old, buy it on somebody else. Use their life. Right? Grow that tax-free money on their life, not yours.
Yeah, it's probably something we're not thinking about.
Well, go ahead, sir.
We recommend, grandparents always want to do something for their grandkids. Well, they do a 529, they put some money in, just grow, maybe. Buy life insurance for the grandchild. When they're now of age with a family, they will have, in case they can't qualify, they've got life insurance. If you put in $2,000 a year for your child for 20 years, they'll be millionaires by the time they're 70. Well, what else can do that? They can pull money out for a wedding, for college, for down payment on a home. It's a very leverageable product.
So here it is. Here's the rule. Do not dismiss life insurance. Don't dismiss it. You want to use it and get with someone who can help you. If you want to learn more about saving for retirement, give the team at Heafner Financial a call. The number is 704-552-1230, 704-552-1230. Now, the first 5 callers will receive a complimentary, no-obligation financial review. That's good. And again, the number is 704-552-1230. Also, you can visit Jim on his website, you'lljustknow.com. I love it. You'lljustknow.com. You need to get in touch with this man indeed. Anyway, thank you very much, sir.
Thank you so much. Learning so much on a Wednesday. All right.